Hey guys, what's up? Welcome back to another video. In today's video, I have a stock that has actually tumbled quite a bit over the last year, even though their financial statements, upon further analysis, show that their business is actually improving. So just wanted to talk a little bit about this company and then figure out what the intrinsic value per share of their stock price is so we can know if it presents a good buying opportunity from a value investing perspective. So please leave a like on the video, helps this channel grow a lot and helps this video get recommended to more people on YouTube. And without further ado, let's get right into it. So the company I'm going to be talking about in this video is Fleetcor. And we can see that over the last year, Fleetcor is down about 30% in the same year that the stock market is down about 12%. So Fleetcor is underperforming the market at the moment. And we can see that they're actually trading near the lows that they experienced in March 2020 when the entire market crashed as a result of the global lockdown and the pandemic. So they could potentially present a really interesting buying opportunity at the moment because of that. And so anyone who is watching this video who doesn't know, Fleetcor is basically a business that helps other businesses and companies control their spending and automate and streamline their payment processes. So they offer different payment cards for different products in the global economy like fuel, lodging, toll and parking, and travel and entertainment. And they also offer automation systems to help different companies with their accounts payable. So that would be like the accounting department for different companies, as well as cross-border payments and purchasing cards, as we saw below. And so if we look into their financial statements right here, this is their balance sheet from their quarterly report showing their second quarter earnings results. And we can see right here for their balance sheet that it's comparing their June 30th, 2022 balance sheet to their December 31st, 2021 balance sheet. And we can see their total assets during that period have grown from about $13.4 billion to about $14.7 billion. And we can also see that the majority of their business is financed by debt as opposed to equity. They have close to about $12 billion worth of liabilities, as we can see right here. And they have about $2 billion worth of total stockholders' equity. And we can also see upon further examination that their retained earnings have increased from their prior balance sheet to their current balance sheet, which means that they've obviously been producing positive earnings and they've been saving that capital in their business. But even with that said, their stockholders' equity has actually decreased, and that's come as a result of an increase in their treasury, an increase in their treasury stock account. And anyone who's watching this video who doesn't know what a treasury stock account is, this is basically the account that increases when a company buys back shares of their company. So if this account is increasing, it means that the company is buying back shares, which is obviously going to be reducing their stockholders' equity. And if it's reducing their stockholders' equity, then that's going to improve their return on equity, and that's going to end up improving the share price for their company's stock. So interesting to see. Obviously, you wouldn't want to see stockholders' equity decreasing as a result of a decrease in retained earnings. That could be bad. But decreasing as a result of an increase in the treasury stock is actually a good thing. So that's very interesting to see. And so if we scroll down here to their income statement, we can see they're comparing their year-over-year results for the 3 months ended June 30th, 2022 to June 30th, 2021. And they also have the first half results on the right side, but I'm going to focus on the second quarter results. So we can see their net revenues year over year have increased from about $667.4 million up to about $861.3 million year over year. So that's an increase of about 29% in their top line. And then if I scroll down a little bit here to their bottom line net income, we can see that their net income year over year has improved from about $196.2 million in the second quarter of 2021 to about $262 million in the second quarter of 2022. So that's an increase of about 34% over their net income year over year. So that basically means that their revenues have increased and their expenses have decreased relative to the increase in their revenues, resulting in an even greater increase in their net income than the increase in their revenues. So that's pretty interesting to see. And then on top of that, if we look at their earnings per share here, their earnings per share have increased from about $2.30 to $3.35, which is an increase of about 46% year over year, which is an even bigger increase in the net income and the revenue. And basically what that tells us is that not only is their net income increasing more than their revenues are increasing, but they're also buying back shares in their company, which is reducing the amount of average shares outstanding in their company, which is obviously being divided into their total net income to get their earnings per share. And that's why their earnings per share is actually increased more than their net income, even though earnings is obviously the same as the net earnings for the company. When they divide it by the share here, we can see the percentage has actually increased more than net income because their average shares outstanding has decreased. So a lot happening on this income statement right here, but basically to sum up in layman's terms, it means that they're trying to return as much value as possible to their shareholders. So that's always a great thing to see for an investor. And so if I go to their cash flow statement right here, we can see they're comparing their first half results for the year of 2022 to 2021. And we can see that although their net income has increased, their cash flows from their operating activities has actually decreased. And that came mainly as a result of the fact that a lot of the activity they've experienced in the first half of 2022 has been credit activity. So we can see that they've gotten a lot of net income and increased their revenues, but a lot of that is sitting in their accounts receivables account. So although they've experienced those revenues, they haven't actually received the cash yet. And so that's why it's a reduction on their cash flow statement. And then also for their expenses, we can see that a lot more of their expenses for the first half of 2022 are being bought on credit as opposed to in 2021. So they're basically incurring the expenses, but they haven't actually given away the cash yet for the purchases that they've made. And so that ends up getting added back to their cash flow statement as well. And that's why this decrease in their net cash provided by operating activities mainly has occurred. And so I also wanted to look at their financing activities, and we can see here the repurchase of common stock entry line right here in particular shows that they've been repurchasing a ton of common stock in the first half of 2022, seeing at about $800 million worth of repurchased common stock compared to about $400 million in the first half of 2021. And that's one of the reasons why we saw on their balance sheet that their treasury stock account was increasing so much, is because they're repurchasing so much common stock, trying to return as much value as possible back to their shareholders. And if you remember, we saw that also on their balance sheet that the majority of their business is financed by liabilities as opposed to equity. And we can see that's coming mainly from the fact that they're raising a lot of money by issuing notes payable, sitting at about $3 billion worth of debt that they've used to finance their business from issuing notes payable. But then that being said, they're also making large principal payments on their outstanding notes payable amounts at about $2.7 billion as well. So a lot of cash inflows and outflows happening from their financing activities here, and that we end up seeing that on their balance sheet as most of their business is financed by liabilities as opposed to equity. And so now I want to do a discounted cash flow analysis after looking into their financial statements. We saw that they have a lot of debt sitting on their balance sheet, and then on top of that, they have positive cash flows from their business. So I wanted to do a discounted cash flow analysis to figure out what the intrinsic value per share for Fleetcor could be. And we can see right here, I got these estimates from Yahoo Finance, or some of them, and then the other ones I got from their actual financial statements. So from Yahoo Finance, they're basically estimating that the future growth rate for the next 5 years for Fleetcor is going to be about 15%. And so for the next 5 years after that, I was conservative and I cut that value in half to about 7% because I just prefer to be conservative in my valuations for companies. And then for the free cash flow for 2021, that amount came out to be about $1.09 billion. And at the moment, if I net their total cash against their total debt position on their balance sheet, they have about $5.45 billion worth of debt, and they currently have about 75 million shares outstanding in their business. And so with these metrics in mind, we can see that the present value of their future cash flows right here, if we discount them back at 10%, comes out to be about $21.48 billion. The intrinsic value obviously being the present value plus the debt position on their balance sheet comes out to be about 16 billion. And if we divide that by 75 million shares outstanding for their company, we can see the intrinsic value per share for their share price for their stock in the stock market comes out to be about $213 per share with a 30% margin of safety of 149 and a 50% margin of safety of 106. So basically, if you wanted to buy into the company at what they're currently valued based on the projections for their future cash flows growing at 15% and then 7% for the next 10 years, you would want to buy in at about $213 per share if you wanted to experience a 10% return compounded annually at minimum. And then if you wanted to be even more conservative than that and assume that your calculations could potentially be off, then you might want to buy in at a 30% or a 50% margin of safety, which would be at about $149 or $106 per share, respectively. And so if we look at their current share price for their stock price in the stock market right now, we can see they're currently trading at about $187 per share, which puts them at less than their intrinsic value per share of $213 and a little bit higher than their 30% margin of safety. So they are trading below their intrinsic value per share at the moment, which could mean that they present a good buying opportunity depending on what kind of a return you would want and what kind of a discount rate you were using to value their company. And so now what I want to do is look at their competitors in their industry so I can get a better understanding of if they're actually measuring up against the industry standards for their competition. And so I Googled what some of the biggest competitors were for Fleetcor, and it basically came out to WEX and Donnelley Financial, I believe that's pronounced. And those are basically two other companies who also focus on helping other businesses with their payments and with their finances. And so we can see right here that I compared their gross profit, net profit, and return on assets ratios. And across the board, it looks like Fleetcor is beating out their two main competitors here by a pretty substantial margin of about 20% in their gross profit margin. And they're definitely beating them out way more in terms of net profit margin. WEX's net profit margin was actually so low as a result of their income statement, which when I took a look at it, they basically had a couple $1 million worth of sales, but then they only had like $100,000 of net profit. And as a result, their return on assets and their net profit margin end up being close to 0%. And then we can also see that Donnelley Financial has a lower net profit margin than Fleetcor, but they have a higher return on assets. So they might be optimizing their assets a little bit better than Fleetcor is so that they can get a return on their business and a return on their investment. But based on this competitor analysis here, I would say that Fleetcor probably holds the edge just because their business is way more profitable than the other two companies. So from that perspective, if I were to decide which of these companies to invest in from a competitor's standpoint, I'll probably choose Fleetcor. And then on top of that, we can see from doing the discounted cash flow analysis that they're currently trading below their intrinsic value per share based on these metrics right here. So from both of those perspectives, it looks like Fleetcor could potentially present a good buying opportunity, especially considering the fact that when we looked into their financial statements, they were experiencing a lot of earnings growth, as we saw from their income statement. So based on that, I might be keeping my eye on Fleetcor in the future just to see where their stock price goes and see maybe if I want to buy into it. But I would definitely love to know what anyone watching this video thinks about Fleetcor, if it's a good buying opportunity at the moment or not. Let me know in the comment section down below. I'd love to hear your opinions. Subscribe to the channel, leave a like on this video, and I'll see everyone in the next one.